Hello and welcome to the December 22nd, 2023 episode of Watching the Tape. Did you know that the average annualized return on the S&P 500 index has been 10% since the index was established in 1957? 10% just for owning a diversified basket of large cap US stocks. Who wouldn't sign up for that? And it just so happens that the S&P 500 index has returned an annualized 10% over the last 3 years, right in line with historical averages. So 1 million invested on January 1st, 2021 would now be worth 1.33 million, representing a compound annual return of 10%. But that's not the whole story, is it? Let's look at the actual path of stock prices over the last 3 years. In the first year, 2021, stocks returned 29%, an incredible year. In the second year, 2022, stocks fell 18%, not good. And in the third year, 2023, which is rapidly coming to a close, stocks are up over 25%. It's been a wild ride. So while, yes, the average annual return on the S&P 500 over the last 3 years has been 10%, and over the long term, dating back to its inception in 1957, it's been about 10%. The reality is that it's rarely ever that close to 10% in any given year. And it can be quite an uncomfortable ride at times. Let's consider this up and down volatility from two very different perspectives. First, let's look at it from the standpoint of pre-retirees who are still in the middle of their working careers and are in the wealth accumulation phases of their lives, meaning that they are contributing to their portfolios. They're not drawing from them. They clearly have the luxury of being able to ride out the ups and downs of the stock market because they have time on their side. Second, let's take a look at it from the vantage point of retirees who are drawing on their portfolios to fund their lifestyles. They would not want to be pulling money from the stock portion of their investment portfolio after stocks are down 18%, for example, like we saw in 2022, because they would be missing out on giving their stock investments a chance to recover the lost value. And this is why retirees should have a larger portion of their portfolios in fixed income securities bonds, which can be a source of money to pay for life's expenses, leaving the stock portion of their portfolio to recover over time. That is it for this week. Merry Christmas, have a Happy New Year, and we'll see you in 2 weeks.